Okay, we're beginning now. So we're going to do options trading, how to get paid to buy stocks. My name is May Dildalau. My blog is yesfinanciallyfree.com. A little bit about myself. I live in Waikiki. That's my husband Jamal, our son Jordan, he's 12 now. And my mom down here is down over here. I used to have a lot of credit card debt in 2011, more than my annual salary at the time, which was only 36,000. By 2016, I paid off all the debt. In April, our net worth had improved by about $500,000. We were making almost $500 a month in passive income. I quit my job on December 23rd, and I started Finance Freedom Coaching. In 2017, we bought our first property together in Waikiki. It's a condo. 2018, we sold. No, actually, we bought another one in the same building. It's an Airbnb business, which we still run today. And in 2019, we sold the first one, and we moved into this one, which is bigger. It's a 3-bedroom condo in Waikiki. So I have an earnings investing disclaimer. There are no guarantees in investing. I'm showing you information that if you follow it, there is no guarantee that you'll make money. This is an informational presentation only. Do your own research before investing your money. There are no guarantees in investing. And why am I teaching you for free? There are 3 reasons. First, I used to be really bad with money, and I learned a lot from a lot of free training, so I'm paying it forward. I'm building a new video library for my inner circle. It's a subscription service. It costs $9.67 a month. And I worked very hard to make this presentation extremely informative and valuable to you in order to show you my abilities. It is my hope that you will be so impressed that you'll be interested in the products and services that I will introduce you to. All right, let's begin. One method in options trading is to get paid to buy stocks when they decrease in price. Yep, I was amazed when I first heard this, okay? I can get paid to buy stocks for cheap. Yes, in this presentation, I'm going to teach you this basic options strategy and show you how to program trades into your brokerage account. What is an option? An option is a legal contract that gives you the right to buy or sell an asset. Think stock or ETF at a specific price by a specific time. You pay a premium to buy an option. You earn a premium when you sell an option. Parts of an option contract. Okay, there are parts to a contract, okay? You have a buyer. The buyer pays a premium. You have a seller. The seller gets the premium. You have an expiration date for the contract. There is a stock price in the contract. We call it a strike price. There is also a type of option. There is a call option or there is a put option. A call option is exercised or executed when the stock price goes up to the strike price. Okay? Strike price is the stock price. They just call it strike price, right? Instead of stock price. A put option is exercised, executed, when the stock price goes down to the strike price. So call options go up and puts go down. Do you have any questions so far? All right, moving on. How to create an options contract. A potential buyer goes to the options marketplace and they ask if someone wants to sell them an options contract for a certain premium. I got 500 bucks here. Can someone sell me a contract for 500 bucks? They're asking the market. Okay? A potential seller goes to the options marketplace and they offer bids. They're like contractors. We're talking about contracts, right? They're contractors. They're offering bids. I can do this, what you're requesting for this much money, right? The premium. The money is the premium. If the potential buyer and the seller both put in an order in their brokerage account to do this, and they match in what they want and the premium they want, the ask matches the bid, the premium is paid and the contract is executed. If there is no agreement made, then the contract is not made. You know, you could be in the marketplace saying, I want to pay this much, and everyone's like, no, you need to pay me more. And they're like, well, I don't got it. So there's no contract, right? You could go to the marketplace and someone's like, you know, I need to be paid this much. And they're like, no, I can't afford you. And then there's no contract. Okay. So this is how contracts are made. That's why you put in orders and sometimes they're executed and sometimes they aren't, because you need to have someone on the other side agree to this contract. Okay, here's an example of selling a put contract for Apple when it's $333 a share. If you pay me $450, I will buy your 100 shares of Apple stock if the price of Apple decreases to $315. This contract is good until August 14th. All right, this is an example of a put contract that you could sell. And this is your, remember, $333 a share. The strike price is $315. The premium is $450. You're in the marketplace and you're saying, hey, if you're interested in this deal, I can offer you this. I have enough money to buy your 100 shares of Apple stock, which would mean that you have $31,500, okay, ready to go, okay? Because Apple stock is $315 a share. You're saying I can buy it, all right? That means you got to have the cash on hand. It's a lot of cash for Apple, but that's how it works. You earn premiums by selling those options. So we're going to talk about selling cash covered puts. These are called cash covered puts. It's a basic strategy because you have the cash in the account and the brokerage account actually locks up your cash. When this order is executed, your cash is in the account ready to go in case the contract is fulfilled. So if you sell a cash covered put, that means you already have the cash to buy at least 100 shares of a stock. For example, selling a put option for Apple stock now at $333 a share might look like this. If you pay me $450 premium, then I will give you the right to sell me 100 shares of Apple stock at $350 a share on or before August 14, 2026. After that, the contract ends. This is like getting paid to buy Apple stock at a discounted price. Even better, you keep the premium no matter what. So as soon as the contract goes through, the premium is yours. Whether the strike price, whether the Apple stock goes to $315 or not, you keep the premium, okay? So here's some specifics. Cash covered put options gives the holder the right to sell stocks at the strike price from a seller who has the cash to buy them. One options contract contains 100 shares of stock. It is beneficial for the seller in two situations. If the market price stays above the strike price, the seller keeps the premium and the cash. If the market price is at or below the strike price, the seller buys the stocks for a lower price than if they bought it today, and they also keep the premium. Okay. If you sell cash covered puts, you have to be okay with buying stocks at the strike price. Okay, review. If a cash covered put expires, what happens? You guys remember what happens?
Well, if it hits the strike price, then you buy the stock. If it doesn't, then you just get the premium.
Right. You get the premium if you buy the stock.
Either way, right?
Yes, either way. Yeah, exactly.
Yeah.
You get the premium right away. So it just comes right away, no matter what happens. As soon as the contract is enacted, you have the premium in your hand. Cash covered put expires, just like Ken said. If the stock price does not go down to or below the strike price before the expiration date, then you keep your cash. If the stock is below the strike price or at it, then you buy 100 shares of that stock at $315, no matter what the current market price is, and you keep the premium no matter what. Here are the risks to selling cash covered puts. If the stock is at or below the strike price, then it can be exercised. That means it can be executed, all right? This means, say the price of Apple is $305 today, all right? If the buyer exercises the put today, or if the option expires today, you would have to buy the stock for $315 a share. So you just overpaid $10 a share, right? That's $1,000, yeah? Tax risk. The premium you earn is always a short-term capital gain, okay? Loss of profit risk. Your cash is locked up during the contract period. Depending on your brokerage, you may earn interest, but you might not earn anything, all right? Risk example. So we're going to sell a cash covered put. You sell the Apple put contract for $450 with a strike price of $310 a share instead of buying Apple at $327.50 a share right now. Okay, so you have two choices. You're like, oh, I want to buy Apple stock. You could buy it right now for $327.50, or you could do this put contract. You decide to do a put contract. The next day, Apple is up $334.33. You missed out on a $6.83 gain in one day, right? So that's $683 total because 6.83 times 100 shares is $683. You earn a premium of $450 instead of getting that $683 in capital gain. If the stock price continues to rise to $350 a share, you miss out on all those gains too. In addition, your cash is locked up for another month, not making any dividends or capital gain. All right, so you miss out on the opportunity if you want to buy the stock and it starts going up, you miss out on that if you're locked in a put. This is another risk. You sell the Apple put contract for $310 a share, strike price, instead of buying Apple at $327.50. The next week, Apple is at $250. So it went the other way, it went down, right? And your option is exercised early, right? They just like want it now. So right now you're paying $310 a share for a stock that could be bought for $250 a share. You lose $60 a share or $6,000, right, in potential profit. Would you be okay with that? You guys understand those examples? Do you understand the risks I just mentioned? Do you want me to go back? You understand the risks?
Yeah.
Yeah? Okay. Move on. All right. So if you don't like that idea of losing out potential profit and all that stuff, now all this is assuming that you can predict the stock market. No one can predict the stock market. So you have no idea if the stock will go up and down like that. And some of that is real life. The Apple stock did actually increase $6.83 in one day because I was making this presentation over a 3 day period, and that's what happened to Apple stock, right? It jumped up $6.83. So, I mean, it happens, and that was the actual premium at the time. So, if you're okay with this kind of risk, then let's go. Here are the step-by-step instructions for selling cash covered puts. First of all, you have to get approved by your brokerage account. Did you guys apply for approval? Did any of you apply yet to do options trading?
No.
No, not yet. Okay. Yeah, you need to get approval first, right? And then you can do these things. So you just hit apply. There's going to be something in your brokerage that allows you to apply. And you can always call customer service. And they have different levels. You want to do the lowest level. The most basic level is called covered, right? In Schwab. I don't know what they call it in other brokerage accounts, but basically the basic level is what I'm teaching you to do, is all basic stuff. Takes about 24 hours before approval.